Hi there, and welcome to week 6 lecture of Finance, Financial Markets and Institutions. And in this week's lecture, we're going to look at the various types of financial crime and the regulations and law in place to prevent such crimes. So far in this module, we have covered the likes of regulation in general, additionally rules-based and principles-based. We've looked at how the different types of regulators are there, such as the prudential regulator for supervision and the conduct authority, and their role in the manipulation of behaviours within the financial services sector. In other words, how they authorise individuals and firms to operate in a fit and proper manner to uphold integrity and act with due skill, care and due diligence. We've also looked at the likes of financial ethics and some of the ethical principles that individuals should uphold when working within the financial sector. And all of this regulation, ethics, and the authorization process is really designed to ensure that the likes of financial crime don't happen and promote confidence within the financial markets and towards consumers. But we've also covered the likes of the whistleblowing process, which is a process where if individuals spot such activity or unethical activity, then they can inform the management of the firms. Therefore, it can be addressed appropriately. Quite a lot of financial crime actually is identified after a whistleblower, with many of today's live examples actually resulting from the whistleblowing process. So, what are we going to cover? Well, we're going to look at the 7 different types of market abuse. Then out of the 7, we're going to focus on insider dealing to explain what is insider dealing and what potentially constitutes as not insider dealing. Then we'll look at the money laundering process and how financial firms can prevent themselves from money laundering and the role of the money laundering reporting officer. We'll also look at the likes of bribery and corruption. And then lastly, we'll look at other related laws such as terrorism financing, which again heavily links to the likes of money laundering and bribery. So, firstly, we'll start with market abuse. So, the Market Abuse Act was written in the Financial Services Market Act of 2000. And as you can see from the slide, market abuse arises where investors have been disadvantaged by others who do the following. So provide material information. Now, first of all, what is material information? Well, this is information that's not available to the public and it could potentially move the likes of an asset price. Market abuse could be someone that is distorted or rigged the price setting mechanisms, such as the likes of the LIBOR rigging scandal, where we'll cover shortly, where individuals colluded to artificially inflate the LIBOR rate. Or lastly, it could be someone that provides false information or misleading information to the public. And the legislation states that there's 2 core themes here, which is really insider dealing, which kind of links to the first bullet point, or market manipulation, which relates to the second 2 bullet points there. But within these definitions, there is 7 types of market abuse that we will cover. It is worth noting in the EU, from an EU directive of 2003 on market abuse, this act is actually civil law rather than criminal law. Thus, insider dealing would tend to be done through the civil courts against a claimant rather than the criminal crown courts in the case of the UK. However, in some cases, the crime will actually fall under criminal law rather than civil law. So civil law is when you typically have a claimant against a person, like suing. But with criminal law, this is where you have actually caused a crime against statute and is public, therefore you're liable to public prosecution. So let's have a look at the 7 different types. So the first one is insider dealing, and we'll cover this in detail shortly. But I think this is what majority of you may relate to or heard of in the past, is where you have somebody within an organisation that has knowledge of an upcoming event, and therefore they act on that information ahead of everybody else. The second one is improper disclosure. In other words, thinking of this is the likes of tipping off. So you're not willingly given this information, but you might have done an improper disclosure, just like tipping someone off in passing, or disclosing something when you probably shouldn't have without knowing. The third one is the misuse of information. So this is where an individual may get information from an insider dealer or tip off, and then actually acts on that. So they will know this information is not publicly available, and they'll potentially try and get edge. The term get edge is used in the How to Catch a Trader documentary, which we require you to watch as part of the seminar and independent learning of this week's teaching and learning plan. The fourth one is the manipulation of transactions. This is also known as wash trading, where potentially you're manipulating the market by making a series of trades, whether that be buying or selling on large quantities, and ultimately your goal is to distort supply and demand, which will artificially change the level of the price if we're talking about the likes of shares. So for example, if you are trying to do this and you place large orders of certain stocks, you never know, this could be picked up by artificial traders who notice volume increases, therefore they also trade in when they see volume signals. Or obviously the opposite when it comes to selling. But this could also be the likes of boiler room scams, which you covered in a previous lecture, where you'll have people trying to sell you a certain stock that they already own, so it drives the price up. The fifth type is the manipulation of devices. In other words, creating false accounts, or it could be the creation of accounts that are not fully disclosed and therefore avoids the likes of internal and external auditing. So we'll cover this in the likes of the Nick Leeson case at Barron's Bank, where he created a fake 88888 account, which was not really picked up by the internal auditors, yet lots of transactions were going through this fake account. Number 6 is the dissemination or the willful dissemination of false or misleading information, and this can be the likes of the wealth management industry, where your potentially advisor is not acting in good faith and they're willfully passing on misleading information to get their customer to potentially place an order or deal with them for whatever reason, whether it be commission based or if the advisor has a holding in that stock. So again, this sort of behaviour is really to try and distort the likes of supply and demand, or get someone to act in a manner they shouldn't because the information provided is incorrect. And the last one, distortion or misleading behaviour, is the likes of herding. So you as an advisor could act in a certain way which will potentially give out false information or suggest the likes of supply and demand or volumes is different to what it actually is, and this would be to get lots of investors on board to potentially manipulate the likes of the share price again. But ultimately this would distort the market, which will ultimately impact the price of whatever the asset may be. And the person doing this will probably be the owner or have a high level of stock in the likes of this asset or share, which will ultimately give them financial reward. Given that there are 7 different types, a few of them do seem rather similar in characteristic. Therefore, I'd highly recommend you to spend some time going through each of the 7 to fully understand how they differ from one another, or to provide an example of where the likes of these 7 different activities could take place whether that be within the trading business or the likes of wealth management or the advisory of consumer products. So let's look at some examples. Here we have a case of Elon Musk from August 2018, and this is where he got onto Twitter, and as someone high up in the organization and someone that has a high level of equity in this firm, he tweeted out he's considering taking Tesla private at this cost per share. Now, is this insider trading? Did he move some of his shares before doing this? Or is it willingly disclosing wrongful, misleading information? But also, did he disclose this information in the correct process? Because typically, the head of a firm that's going to make such an announcement will inform the stock exchange first, and then that will get disseminated, rather than just putting it onto Twitter and letting the public see it all in one go. Obviously, following this tweet on the 7th of August, you can see the volume was quite high on trading. You can see the volatility in the share price following such an announcement. So, is this behaviour from Elon Musk market abuse? Yes or no? Well, it's an interesting one because he was sanctioned by the US regulators for doing such a tweet. He was required to pay a level of fine. He was also told to step down from his role and have someone else in charge of the organisation, but could still be a member of the management team. And to be honest, in Elon Musk's response to that, he pretty much laughed off the fine and just argued it was a tweet. So there's a good example of where, is it insider trading, is it market abuse, or is it just a tweet? So you can have a read into that case. The link is in the description. We also have the likes of the LIBOR rigging scandal, which was where individuals in the Treasury Department of each bank that is used within the panel of banks that set the LIBOR rate. Every day, these individuals from each bank would call each other to inform them of the rate that they were going to suggest, that they're willing to lend at overnight and up to a year. We'll cover more on this when we cover money markets. But ultimately, each member of the Treasury Department of each bank were colluding to slightly artificially inflate the LIBOR rate upwards, so therefore if the banks did lend out, they would receive more in interest. And quite a lot of assets, such as mortgages, savings products, derivatives, are all underpinned by the LIBOR rate. Therefore, this impacted not just traders, but it impacted the consumers, potentially when they were buying the likes of a new mortgage. When this all came to light, there was a review conducted, which ultimately got rid of the British Bankers Association and their role of collecting and publishing the LIBOR rate. It was moved to the ICE benchmark agency, but as of 2021, the LIBOR rate will be no more, and it's currently being phased out with the incorporation or replacements already being used within the financial services sector. Again, we'll cover this more when we do the money markets. But these banks will obviously find quite a bit under civil law, but also there has been criminal investigations into the likes of fraudulent activity or passing on incorrect information, which is fraud. To understand more about this case, I'd highly recommend you read the weekly review into the LIBOR rigging scandal. But also, we have examples of rogue trading. Now, the term rogue trading doesn't just mean they were insider trading. The examples on the screen here vary in what they actually did, so please do have a look at them. But some of these individuals, in fact all these individuals, did end up going through the criminal court system and ending up with custodial sentences. So the biggest fine there that we've seen during the financial crisis was Jerome, who worked for CII General. He was put in prison for 5 years, but I think it was suspended by 2 on appeal. But you can see the size of the losses there, and he was mainly doing inside out rogue trading on the European stock index futures. Second here you have Yashimo. Please apologise if I said that incorrectly, where he was working for Sumato Corporation in Japan, Tokyo, and his activities related to copper. We also have Kiwo, again apologies if I pronounced that incorrectly, and he was actually based in the UK, in London, working for UBS, and he was imprisoned for 7 years, and his activities related to the major equity futures markets such as S&P 500, DAX and Euro stocks. And next we have the case of Nick Leeson of Barings Bank, which was a UK bank that collapsed in 1995-1996, and this was based on the overly exposure to the Nikkei futures, and this was created by Nick Leeson, and he had fraudulent accounts such as the one mentioned previously, where he was putting trades through, which was leaving the bank heavily exposed to the Nikkei futures index, and the likes of the Kobe earthquake happened, which left the bank heavily exposed as the trades were expecting the futures index to go up but subsequently went down. And this ultimately led to the demise of the bank itself, and Nick Leeson was imprisoned for 6.5 years in Japan. And then lastly we have Tosh Heidi. Again, apologies if I pronounced that incorrectly. And again, this is a case from 1995, but this person's activities was relating to US Treasury bonds for Ronza Holdings. So interestingly, we have 5 examples here. We have 2 of them from the financial crisis, and the other 3 are regarding 1995-1996. So this does highlight the variety of what constitutes as rogue trading, what constitutes as market abuse, the different types of products they used, and the different institutions they worked for. But do have a look at the long list of potential rogue traders in the past and see what they did, what products they were trading on or responsible for, and the various lessons learned from said cases. For instance, the Nick Leeson case did make wholesale changes to risk management within firms. For instance, Nick Leeson had too much power. He controlled both front office and back office of a bank, which you really shouldn't do, because the back office is meant to be risk management, front office is meant to be trading. The back office is meant to be ensuring the front office don't exceed certain limits. But if you control both entities, you can see there's a problem there. Also, he was doing this in Japan, and the London office were just sending him money constantly and not asking questions, because what he was doing seemed very profitable, because he'd done fraudulent accounting or profit smoothing, and ultimately he was receiving large remunerations for this. So again, this sort of activity was found out, and steps within the whole banking sector were put in place to ensure this doesn't happen again. So the Code of Market Conduct was set out by the UK Conduct Authority regulator, and in this code, first of all, it sets out what behaviours does not constitute as market abuse, and we'll cover this shortly. And it's given the terminology of safe harbours. It gives you a range of factors that could be taken into account when individuals might want to defend themselves if they're accused of breaking such a code. So let's have a look at what constitutes as a safe harbour and thus is not classed as market abuse. So the first one is any activity that relates to the takeover code. Now the takeover code is in place and this surrounds the activity of a merger and acquisition. So during this process, as you can imagine, there's a lot of insider information and due diligence that takes place, but as long as the individuals involved in this activity from both parties conform with the takeover code, which again means don't disclose the information publicly, then any activity or information sharing that satisfies the takeover code does conform with what is not classed as market abuse. The second one is the likes of firms when they have their own share buyback schemes, or if they do the likes of stock splits to stabilise the price. But this sort of information tends to be fully disclosed in advance via the stock exchange. Therefore, the likes of any share buyback scheme or any sort of rights issue that firms do in the appropriate manner, which is fully disclosed, again, it does not class as market abuse. And then lastly, any sort of act that's done by a public body does not constitute as market abuse. So this is basically any sort of central bank intervention. So this could be monetary policy changes, this could be the likes of central banks interfering in the foreign exchange markets, it could be where they issue new levels of debt or change their foreign reserves. So any activity by a central bank or a public authority does not constitute as market abuse, but yet their activities may have significant consequences in these said markets. So again, we have the likes of examples here. So if we look at we look at the currency graph in the middle, this was the case of when the Swiss central bank pegged their currency against the euro in 2011 to try and stabilize the currency with the euro, but this got very expensive. I don't know if you can see this well on the graph, but on the right hand side you can see in January 2015 when the Swiss central bank overnight decided they didn't want to be pegged with the euro anymore, and this made the Swiss franc jump up 30% in value overnight. And the outcome of this, there was a range of foreign exchange companies that didn't have the liquidity, and thus they went bust. The Swiss stock exchange dropped because all of a sudden their company's commodities or products were 30% more expensive than their European counterparts. And lots of people in the tourism sector, because that was kind of the peak skiing season at the time, all of a sudden people that were going to go to Switzerland found out their currency was 30% more expensive than it was the day before. So people that hadn't paid for the likes of hotels, consumers also lost out. And there's also other examples relating to the US and China when they're involved in potentially artificially changing their own currency to influence trading activity. So again, this sort of activity is not classed as market abuse because it's done by public bodies, but potentially they have wider implications on asset prices, and they also do attract a lot of media attention when the state does intervene in the foreign exchange markets. And this concludes the first part of the lecture. Hello, and welcome to the second part of Week 6's lecture on financial crime and the regulations surrounding financial crime. In this part, we're going to look at the actual crimes in a little bit more detail. And we're going to start by discussing insider trading, which is one of the 7 acts of market abuse. So what is insider dealing? Well, firstly, it surrounds the concept of asymmetric information. And this is where one party knows more than another. And it's the lawful activity of using this knowledge to gain an advantage. So, the definition is trading with access to material and non-public information. Now, the concept of material means it's significant that it could potentially influence the likes of a price. And non-public, as you can imagine, is not in the public domain and only known by a few entities. So who is an insider trader? An insider can be classed as anybody who has privileged information, such as through their employment, i.e. they may be a higher member within the organisation, and their activities and their decision making can influence the likes of the share price. It could be the likes of a major shareholder, where they may have certain information due to their capital holdings and their significant influence when it comes to the ownership of the organisation. It could be anybody that's accessed this information by criminal activity, whether that could be through hacking or through the likes of leaked documents. Or it could be anyone that's got the likes of a tip-off from a friend of a friend. So if we look into this in a little bit more detail, here's an example of what an insider dealing could look like, where you have two companies that are discussing the likes of a takeover bid. Now, as mentioned, there is the takeover code that's in place, but the likes of disclosing information surrounding this merger and acquisition or takeover to an external member falls foul of the takeover code and then does become the likes of insider trading. So somebody within one of the companies can tell a person outside of the takeover talks, and then this person can make the likes of a trade on the share price. So when the announcement happens, typically that shifts the price of a firm. In this case, the share price goes up by 30 pence, and then person A benefits from this and sells off their stock. So ultimately, the benefactor here is person A, somewhere outside the organisation. They've benefited from a share price rise, making a substantial amount of profit. Now take a moment here. Who's the actual victim of this crime? Is there a victim? Well, technically, there is, yes, of course. The market as a whole didn't have this information, but someone was able to take advantage of this, and they potentially bought shares from someone else that didn't have this information and benefited. Thus, the person that sold the shares lost out, potentially. So it might seem like a victimless crime, but ultimately, the market loses out here and other shareholders. So I have a question. In this chain of events, so say a director of a firm knows that the results of their annual profit and loss is going to be published in 5 days' time. Now that director has obviously been working with the likes of an analyst in recording the profit and loss. But what happens if this analyst tells a colleague in a different part of the firm? Then this colleague might tell a friend or a family member that it's looking good, the share price might go up, but then this family member or friend potentially tells a friend of a friend, and then someone makes a trade. And of course that person will eventually benefit 5 days later, and they do. Who's at fault here? Who's the insider trader? Is it the friend of a friend? Or is it the whole chain of activity? Technically, if found out, then potential all members of this chain are classed as insider traders because they were technically tipping off each other, then ultimately someone did benefit. But again, it's probably very difficult to prove this chain of events without some sort of concrete evidence. So what is kind of considered as privileges to information throughout this sequence of events? Well, ultimately, it's anything that could influence the price. Anything that's not publicly known ultimately it's information that helps base or inform decision making within inside a firm. So anything else outside of that is not classed as privileged. So the likes of academic research, financial analysis forecasts, any information off Bloomberg, any sort of company report that's provided to investors via the stock exchange, or the likes of profit and loss, earnings calls, all of them are publicly disclosed information. So the privileged stuff is really the information that is potentially going to inform a decision along the line that could manipulate the likes of a share price. So, in this chain of events, how do you defend yourself in the case of being accused of insider trading? Well, you have to kind of prove two things. You must prove that the information was not privileged or price sensitive information. So that's the first one. And the second one is that this information, whatever you received, did not influence your original decision. So your defense could be, I didn't know it was privileged information and I was going to buy the shares anyway. Of course, that's not very robust. Therefore, you must provide evidence that you didn't think this information was privileged, or that you are going to potentially buy or sell the shares anyway, and this new information did not influence your decision in the slightest. But as you can imagine, this is based very much on principles, so principles-based regulation rather than rules-based. Because the principles are you have to defend saying you didn't believe it to be privileged and therefore it didn't influence your decision making. You're going to do that anyway. And that, as you can imagine, is not very black and white. It's not box ticking. Thus, it is principles-based. And that's where potentially the criminal or civil court jury would have to make a judgment based on your defence. So, the next case we're going to look at is money laundering. And what is money laundering? And in the seminar, we're going to look at the likes of the FinCEN papers, which gives plenty of examples of money laundering. So, what is it? Well, money laundering is the process in which money generated through illegal activity is ultimately transformed into legit legal money. So ultimately, it's the concept of turning dirty money into clean money, hence the name laundering. And the definition of dirty money or illegal money is very varied in its definition, but ultimately it's any sort of cash that is generated through the proceeds of crime, whatever that crime may be or wherever that crime may take place. But it's not just potential money, it could actually be assets or property that has been obtained again through the likes of crime. And it's the conversion of this cash or property or asset into kind of clean or legit. It's the process of money laundering. And in this money laundering process, there is 3 defined stages. So these defined stages are placement. Now the first element is where you have achieved or you've received this sort of dirty money or illegal money, and then you have to try and deposit it or place it into the financial services sector. And this placement could be done in various different ways. One of the key combats to placement of illegal money is the Know Your Customer policy we covered earlier. But potentially you could make lots of small deposits into a financial institution rather than large lump sums, because lots of small deposits over a period of time may minimize the level of suspicion the bank may have on you. Potentially you could deposit your sums of money in the likes of tax havens. So if you remember the Panama Papers, which was released to the press a number of years ago, have a look at the outcome of the Panama Papers, which did evidence the likes of illicit money being placed in tax havens through said firms. And potentially you could lend money to a business. So you lend this illegal money to businesses through whatever means, and then this business pays you interest and pays you the money back. So it does actually look like a legitimate transaction. So when you place it into the financial services sector, you can say the money was received from said business for some sort of activity you may have done for them, or some sort of payment. Now the second process, when you potentially have placed your finance within this sector, is known as layering. And this is basically a series of transactions where you may shift the money or the asset around the banking system or through a number of banks, thus concealing where it actually originally came from or where you originally placed it. And this could be through using various accounts. You may wash it through the system via business, so potentially this is where casinos, hotels and the likes of Uber have been accused in the past of potentially transactions going through said firms, or even the hospitality sector, potentially creating a trail of transactions or trail of paperwork to suggest the original place did not come from criminal activity. And then the last stage is fully what's known as integration. And this is where the money really looks legitimate. It's been through a number of transactions, therefore you can't actually place it back to criminal activity. Thus it's legitimized, and then the money's just used and withdrawn to potentially spend on the sort of lifestyle or the purchasing of other assets such as property or investments. And if you want to put it into a diagram, it would look something like this. You may see other diagrams of a very similar nature, but this one is a very simple one to understand. And as you can see, it starts with collecting the dirty money, however that may be, placing it, layering it, and then you have full integration within the sector. As part of your recommended reading or your directed study for this week, I've advised you to look at the work of Professor Jackie Harvey, one of my colleagues here at Northumbria University, where she does a lot of research into anti-money laundering compliance in many countries in the world, but recently she's been working with the likes of the Nigerian government on this. So I'd highly recommend that you look at Jackie's Pure or Research Link profile to read a number of papers and to get an understanding of the work she does on money laundering. But this now leads to the digital age. And what is the role of the crypto assets, or currencies if you want to call them, in the likes of money laundering? Because the popularity of crypto assets potentially originated from the anonymity of where the funds originated. And previously, historically, in the media and through research, you will have seen that crypto assets were really kind of seen as a place for money launderers to shift money around the system and not be identifiable. And still to this day, in many countries, the likes of crypto assets is still outlawed or illegal due to its potential nature of being linked to the likes of financial crime and money laundering. So following this lecture, I would suggest that you do your own research into the history and the role of said assets in the likes of illicit financial crime. But the sector certainly has been on a mission over the last few years to clean up its act, to portray a different sort of image and kind of lose this label of it being used to fund the black market, for instance. So do have a look into this and then obviously make up your own conclusions. But like I said, it is still outlawed in a number of countries. As part of the regulations, certainly in the UK, regarding money laundering, it has acknowledged there is a number of institutional liabilities in place. So if you're a firm that's caught or been involved with money laundering, then you are subject to prosecution. And to ensure that you comply with the money laundering regulations, the firms within the financial services sector must comply with a range of different activities. So the first one I mentioned earlier on was know your customer, KYC. So they must do a full due diligence check on its customers to ensure that their customers aren't involved with criminal activity in the first place. So therefore they can't do the first stage of placement. Also, institutions will have to make potential records, understanding the procedures in place and make a note of the procedures that banks have in the case of detecting the likes of money laundering. They must have certain internal controls, certain risk assessments. They must obviously comply and monitor all their policies. As noted here, they must report any suspicious transactions and have a procedure in place of doing so. And this is where the FinCEN papers originate, because the FinCEN papers were the suspicious transaction reports that they were providing to the US regulatory authority, as they have to. But these regulatory requirements were actually leaked to the Institute of Investigative Journalists, and then obviously eventually published online. But these activities and these transaction reports are required, and then it's up to the bank and obviously the relevant regulatory authorities and law to take on these suspicious transactions and deal with them appropriately. And lastly, obviously all staff in the financial service sector must go through a money laundering training program to make them aware of the laws and the potential implications if you fall foul of said laws. Also, each institution must have a named money laundering reporting officer, an MLOR, and this is the person that's responsible for receiving reports of the transactions that are classed as suspicious from employees. It's also their role to ensure that individuals within the firm know the regulations and do the appropriate training. And the money laundering reporting officer is the person that has to deal with the likes in the UK of the National Crimes Agency or the relevant regulatory body in other nations when they have reported any sort of suspicious activity. Now, the money laundering reporting officer is the person inside the financial firm that is potentially liable to criminal prosecution if the firm is found out to be allowing money laundering to happen and hasn't been reported and disclosed appropriately to regulators. This individual can be prosecuted. Now, a previous work from a former PhD student at Northumbria University, Dr. Abdullahi Bello, he did his PhD under the supervision of Jackie Harvey on the role of money laundering reporting officers, and he created the theory of self-protection theory. From his research and interviewing these individuals, ultimately the money laundering reporting officers were protecting themselves from fines or going to prison. So when they were obviously setting the rules within the banks, they were being very strict, because ultimately if the banks found guilty, this person's the person that goes to jail. So ultimately the officers were looking after themselves to ensure that the bank was very safe so they wouldn't go to prison. And that would make sense when he used a technical grounded theory to create this concept. So again, you can pick up his PhD thesis and have a read of the role of the money laundering reporting officer and the sort of conversations he had with them to create the self-protection theory. But the firm must also take the necessary due diligence in all forms of its suspicious activity reporting, it's identifying of individuals, it's know your customer, and obviously ensure that the processes are followed and that individuals are not informed that they are being investigated regarding the likes of money laundering, because this could result in tipping off. And this is where all individuals need to be informed within the firm about the concept of tipping off, because you may potentially be on the front line, you may be a customer services representative for your firm, and you may see on the notes of the customer that their account has been blocked because they're under investigation for the likes of money laundering. But if you disclose that to the person, if they say, why is my bank account frozen? And you went, oh, it's because we're investigating money laundering. Well, whoever says that is liable to prosecution. And in the UK, you can potentially go through a Crown Court and get 2 years in prison and an unlimited fine. But typically, it would only end up in the magistrates' court, the lower court, and you could receive a fine of up to £5,000. But obviously, depending on the severity, like I said, it could go up to Crown Court, and there could be the likes of a prison sentence involved. And the reason for this is because if you tip someone off, then what are they going to do? Well, ultimately, it could jeopardise whatever the prosecution process would be. They could shift their money somehow, and they could abscond. So it really prevents the course of justice. So anybody, not just the money laundering reporting officer, can fall foul of tipping off and be prosecuted if they do so. That's why all staff in the financial services sector do money laundering training, so they don't do the basic error of tipping off individuals. And going back to the money laundering reporting officer, like I said, if they fail to report this suspicious activity, so they don't produce the likes of the FinCEN papers, or they don't disclose this information, then they are prosecuted, or could be prosecuted again through the magistrates, depending on the size, but could ultimately go up to Crown Court, where they're potentially imprisoned, certainly in the UK, and this may differ around the world. And as you can see, the defences here, they must potentially give reasonable excuses for failing to disclose this information. And again, this is very subjective and is more principle-based rather than rules-based. They must also demonstrate that they've done the appropriate training and that they can recognise suspicious activity. However, in the case where they didn't or failed to report, then they have to argue why potentially in the training this wouldn't have been classed as suspicious activity. And obviously must provide any other related justifications for not reporting any sort of activity in a timely manner. And just to summarise, under the what's known as the Proceeds of Crime Act in 2002, from a UK point of view, we've talked about the kind of liability from the corporate side or the institutional side. Just to recap the individual liabilities. So this does link to what we've already said about tipping off and failure to report, but there's also an element of assistance. So if you're an individual within inside a financial firm and you willingly know that someone is trying to place with you and you help them, assist them to do that, or help conceal transactions as someone that works within the financial services sector, then of course you're allowing the money laundering process to happen and to exist, and therefore you're also personally liable to money laundering. In this case, because you're actually actively involved in money laundering rather than tipping off or failing to report to regulators, this has much wider implications under the criminal courts. So if it goes through magistrates and you end up in Crown Court, then you could ultimately get up to 14 years in prison at the moment under this law, because you're actively doing money laundering, because you're assisting. And ultimately, if you are assisting a criminal, then you are a criminal yourself. And again, in defense of this, you have to demonstrate that you weren't involved, you were unaware of the original sources of this finance, and you have to defend that you potentially weren't assisting the other criminal, or you didn't potentially know them. And again, this would have to be the judgment of the jury if it was in the case of Crown Courts. But ultimately, this regulation comes from a very risk-based approach to fighting crime. Up until this lecture, we've always talked about the kind of good behaviours, how people are authorised, and the ethics behind being an authorised firm within the financial services sector. Obviously, that's a very principle-based approach to ensure that people that work in the sector are fit and proper and appropriate too. But it all comes down to a very risk-averse, risk-based approach to preventing any sort of financial crime to take place. Because if everyone's following said rules and working in a certain manner, then this sort of activity would definitely be spotted, like through the whistleblowing process. And as you can imagine, we've talked about various steps, and certainly when it comes to money laundering, the steps are very similar. So obviously identify, so this could be through the whistleblowing process. Then potentially you have to, when reporting, assess the level of risk to your other customers, to the firm. Whenever you design anti-money laundering processes, you must design it to ensure you cover all aspects that we've mentioned in this lecture, but also to prevent any harm to other individuals or other stakeholders. And as you can imagine, we have to just constantly improve the monitoring system, the communication, the staff training. And if we do this, then we're seen to be in a very compliant manner and ensuring that everybody in the firm has an understanding of what money laundering is and how to prevent such activity. Next, we're going to look at the likes of bribery and the Bribery Act of 2010 in the UK. But again, this sort of Bribery Act, there's very many iterations around the world, but ultimately they follow the same sort of criteria and same sort of basis of what is classed as bribery. So last week we looked at the concept of gifting and the ethics behind gifting and the gifting process. And we're potentially suggesting that if you're given a gift based on past performance, then this would be okay. But if you are given a gift to try and incentivize you to do something, then this is potentially wrong from an ethics point of view, but it could also start to fall foul of the Bribery Act. And ultimately, we need to think about what constitutes as a gift or what constitutes as a bribe. And again, I think we're talking about kind of the monetarization, and the amount of money involved tends to be a key indicator, or what the scale of the gift is. Because you might be given the likes of a nice pen. Now that's not going to arouse much suspicion, but if you're giving someone a week away in the Bahamas, then that's obviously very different to giving someone a pen. So we've got to think about the ethics and the rationale behind this potential gift or bribe. But it also comes down to the element of disclosure. If you're a person within a firm, you must of course follow your firm's process when it comes to disclosure of any sort of gift or any potential bribe. And then it's up to the management or the line manager of the individual to inform them of the policy and what they should and shouldn't do. So every individual within a firm must understand the Bribery Act, but also their firm's gifting policy. And again, there's quite a few blurred lines between them. But the UK Act of 2010 describes 4 main offences under this Act that is potentially known as criminal. So the first one is active bribery, and this is where you effectively offer or give someone a bribe, where you say, if I give you this, will you do that? So active bribery is where you're the person offering the bribe. The second one is passive bribery, and this is where you're the person that agrees. So someone asks you and you go, okay, and you do it, you're agreeing to the bribe. So this is where you're criminal, you're found guilty because you're actively involved in allowing this to happen and you act on the bribe. So obviously in one single transaction, just as the picture at the bottom, two people are breaking this act. One's being the active briber and one's being the passive briber. Number 3 is the bribery of a public official, and that is potentially to make them operate in a way that benefits you as an individual or potentially benefits the firm. So any sort of bribe to a foreign official again falls under this act. But this could also be something very low key, potentially at the border, where a customs officer might be giving you a hard time and potentially ask you to pay a certain amount, which really is not fit and proper, and it's not actually part of the country's immigration regulations or customs. And then you potentially paying this bribe to get quick access or just get through customs is actually part of the bribery act. Obviously the official asking you to pay the money is breaking the law, but you as the individual, you're the passive person here. And you might do that naively, thinking, oh well, it's a customs officer, therefore I must pay. But actually, if you shouldn't pay and it's never been disclosed previously, then technically that's a bribe and you're paying them to get access into the country without any hassle. So there's other examples like that where you may not be knowing you've been involved in bribery there. And then lastly, number 4, if you're an individual or if you're working within the firm, you fail to report any sort of bribery or fail to prevent it from happening, well, that is obviously a crime in itself. So that's the 4 elements of the Bribery Act. Again, that also resonates around the world in various different countries who have a similar sort of act. And lastly, we're going to cover the UK Terrorism Financing Act of 2000. Obviously, I don't want to go into too much detail regarding this, but as you can imagine, sort of any activity that is involved in money laundering or it involves any sort of proceeds of crime relating from terrorism activity, then it falls foul of the Terrorism Act, which in the UK has much larger and more severe consequences than the Money Laundering Act, because the proceeds of crime came from acts of terrorism rather than domestic crime. So this act is in place, which supersedes the Money Laundering Act. So if you're fall foul of money laundering, but the proceeds are from terrorism crimes, then this act would ultimately end you up with a much larger custodial and prison sentence, because ultimately terrorism in many countries is seen as one of the more severe crimes. And as part of this act and the Money Laundering Act, nation governments typically produce a consolidated list of individuals who are potentially known for money laundering or have potential past criminal activities behind them, and therefore governments can produce a sanctions list, and this may be for individuals and firms. Ultimately, a sanctions list means that anybody in this country should not be dealing with these people or firms. If they do, then they're actually falling foul of the law and can be prosecuted for assisting sanctioned individuals. Typically, if people are sanctioned by nation governments, then whatever assets they have held in that country are seized and they don't have access to them. But again, in your own time following this lecture, do have a look at this list and what this means, and what potential firms would have to do if they had accounts for people that have recently been sanctioned by the governing body of a country. Then the firms must seize the assets and pass this information to the regulatory authorities that they hold assets of sanctioned individuals or firms. Again, that links to the Terrorism and the Money Laundering Act, but also this act does lay out 4 areas such as fundraising. So if you're an individual and you're actually actively raising funds that will fund terrorism activity, then that falls under the Terrorism Act. The use or possession of any sort of money or asset that's originated from terrorism, again, falls under this act. If you're potentially selling your own property or selling anything of your own assets to raise money for terrorism activity, that falls under the act. And then lastly, we've covered this in detail, anything to do with money laundering of assets from terrorism also falls under this act, and ultimately will lead to severe criminal prosecution if found guilty. So just to summarise, financial crime, certainly from a UK point of view, we have the Money Laundering Act 2000, we have the 2007, we have the Terrorism Act of 2000, and we have the Proceeds of Crime Act, again of 2000, and this really relates to any sort of asset that's been generated through criminal activity. If the individuals are prosecuted, then these assets are seized, and the idea is that these proceeds of crime are seized and given back to the individuals that were victims of the crime in the first place. And in the likes of the UK, we have the Joint Money Laundering Steering Group, amongst other bodies that stipulate how the likes of the financial system should satisfy the money laundering regulations. Ultimately, know your customer is the key and number one defence in the first place regarding a preventive measure when it comes to money. So, your directed study following this lecture, there's lots of individual crimes we've covered there. I want you to watch How to Catch a Trader for your seminar activity, and that looks at insider dealing. I want you to look at the documentary regarding Parliament's questioning of the banking sector in 2017 regarding money laundering and when this was raised in Parliament. I want you to look at various crimes such as the FinCEN papers. So pull up the FinCEN papers link from the Teach and Learn plan or the email and have a look and read about these and the potential crimes that were reported as suspicious. I also want you to read the paper by Fisher, and as noted throughout this lecture, you can have a look at the work by Professor Jackie Harvey and Dr. Abdullahi Bello from Northumbria University. Thank you.